The stock market, as we know it today, has a long and fascinating history. Its roots can be traced back to the 1600s. Back then, companies were primarily funded by private investors. These early investors sought ways to buy and sell their shares in these companies. This led to the formation of informal trading networks. Coffee houses in London became popular meeting places for investors. They would gather to exchange information and trade shares. One notable company from this era was the Dutch East India Company. It issued shares that were traded in a similar fashion to modern stocks. These early trading practices laid the groundwork for the development of organized stock exchanges. As the number of investors and companies grew, the need for a more structured trading environment became apparent. This led to the establishment of formal stock exchanges. These exchanges provided a centralized location for buyers and sellers to connect. The first recognized stock exchange was established in Amsterdam in 1602. It was called the Amsterdam Stock Exchange. The Amsterdam Stock Exchange set the stage for other exchanges to emerge throughout Europe. These exchanges played a crucial role in facilitating the flow of capital. They connected investors with businesses seeking funding. This period marked a significant step in the evolution of the modern stock market. Across the Atlantic, the United States was also witnessing the rise of stock trading. In 1792, a group of 24 brokers gathered under a buttonwood tree on Wall Street in New York City. They signed an agreement that marked the birth of the New York Stock Exchange, or NYSE. The NYSE quickly grew in prominence. It became the leading stock exchange in the United States. The NYSE's success can be attributed to several factors. These include the robust growth of the American economy and the country's commitment to capitalism. The NYSE provided a platform for companies of all sizes to raise capital. It also gave investors a place to buy and sell shares in these companies. The 1920s, also known as the Roaring Twenties, was a period of unprecedented economic growth and speculation in the United States. The stock market soared to new heights. Many investors borrowed heavily to buy stocks, believing that prices would continue to rise indefinitely. This excessive speculation created a bubble in the market. However, in October 1929, the bubble burst. The stock market crashed, sending shockwaves throughout the global economy. The crash marked the beginning of the Great Depression. It was the worst economic downturn in modern history. The Great Depression highlighted the inherent risks and volatility associated with stock market investing. Section 5, Post-war boom and the rise of technology, a new era for the stock market. Following World War II, the United States experienced a period of remarkable economic expansion. The stock market rebounded strongly from the lows of the Great Depression. New industries emerged, driven by technological advancements. Companies involved in sectors such as aerospace, electronics, and consumer goods flourished. The rise of technology also began to transform the stock market itself. Computers were gradually introduced to automate trading processes. This led to increased efficiency and speed in executing trades. The post-war period laid the foundation for the modern, technology-driven stock market we know today. Section 6, Black Monday and the Tech Bubble, Volatility and the Market Cycle. Despite the overall upward trend, the stock market has always been prone to periods of volatility and corrections. These fluctuations are a natural part of the market cycle, reflecting changes in investor sentiment and economic conditions. On October 19, 1987, the stock market experienced its largest single-day percentage drop in history. This dramatic event sent shockwaves through the financial world. This event became known as Black Monday, a day that is still remembered by investors and analysts alike. The crash was attributed to a combination of factors, each contributing to the market's sudden decline. These factors included program trading, overvaluation, and a lack of investor confidence. The interplay of these elements created a perfect storm. In the late 1990s and early 2000s, the stock market witnessed another period of exuberance. This era was marked by unprecedented optimism. This time it was fueled by the rapid growth of the internet and technology companies. The promise of a new digital age captivated investors. However, this tech bubble eventually burst as well, leading to significant losses and a re-evaluation of market expectations. It reminded investors that even in times of technological advancement, market cycles and corrections are inevitable. Understanding these cycles is crucial for long-term investment success. Section 7. The 2008 financial crisis, a systemic shockwave. The 2008 financial crisis was a stark reminder of the interconnectedness of the global economy and the potential for systemic risks within the financial system. The crisis originated in the US housing market. However, it quickly spread to other parts of the world. It led to a severe recession and a significant decline in stock prices. The crisis exposed weaknesses in financial regulations and the dangers of excessive risk-taking by financial institutions. It highlighted the importance of sound risk management practices and the need for greater transparency in the financial system. Section 8. The rise of fintech, democratizing finance. In recent years, the financial technology, or fintech industry, has emerged as a disruptive force in the financial services sector, revolutionizing the way we handle money. Fintech companies are leveraging technology to provide innovative financial products and services, making financial management more accessible. These offerings often come at lower costs compared to traditional financial institutions, which can have high fees and complex processes. One notable area of fintech innovation is online brokerage platforms, which have revolutionized stock trading. These platforms have made it easier and more affordable for individuals to invest in the stock market, breaking down barriers to entry. They provide access to a wide range of investment options and tools, empowering users with information and resources. This has led to greater participation in the stock market, particularly among younger generations who are tech-savvy and eager to invest. The rise of fintech is democratizing finance and transforming the way people invest, making financial opportunities more inclusive and widespread. Section 9. The stock market today, a complex and interconnected world. The stock market today is a complex and interconnected ecosystem. It is influenced by a multitude of factors, including economic data, geopolitical events, and investor sentiment. Advances in technology continue to shape the market. They enable faster trading speeds, greater access to information, and new investment opportunities. Algorithmic trading, where computers execute trades based on pre-programmed instructions, has become increasingly prevalent. This has raised concerns about market volatility and the potential for flash crashes. However, it has also led to greater efficiency and liquidity in the market. Section 10. Factors influencing the market. A multifaceted landscape. Numerous factors can influence the direction of the stock market. Economic indicators such as gross domestic product or GDP, growth, inflation, and unemployment rates provide insights into the overall health of the economy. Interest rates set by central banks can affect borrowing costs for companies and consumer spending. Geopolitical events such as wars, elections, and trade disputes can create uncertainty and volatility in the market. Investor sentiment, which can be influenced by news flow, social media, and behavioral biases, also plays a role in shaping market trends. Understanding these factors and their potential impact is crucial for investors seeking to make informed decisions. Section 11. Looking ahead, the future of the stock market. Predicting the future of the stock market is inherently challenging given the multitude of factors that can influence market movements. However, several emerging trends suggest that the market will continue to evolve and transform in the years to come, driven by technological advancements and changing investor priorities. Technology will undoubtedly play a significant role in shaping the future of the stock market. Artificial intelligence, or AI, and machine learning are already being used by some investors to analyze vast amounts of data, identify patterns, and make more informed investment decisions. Blockchain technology, the underlying technology behind cryptocurrencies, has the potential to revolutionize trading and settlement processes, making them more efficient and transparent. Environmental, social, and governance, or ESG, factors are becoming increasingly important considerations for investors. reflecting a broader shift towards sustainable and responsible investing. As awareness of climate change and social responsibility grows, companies with strong ESG profiles are likely to attract more investment capital, driving a shift towards more sustainable business practices. The stock market will continue to be a dynamic and evolving landscape influenced by a variety of factors, including technological innovation, regulatory changes, and global economic trends. Investors who stay informed, adapt to change, and embrace innovation will be well positioned to navigate its complexities and capitalize on its opportunities, ensuring their success in an ever-changing market environment.